Hello, my name is Benjamin Z. Meller, and in today's video, I want to just kind of talk a little bit about portfolio allocation. So, friends and clients, they often ask me for advice on their portfolio and if they should, right now, with the higher rates of inflation, if they should just completely exit bonds and instead focus on another asset class, maybe income producing real estate or stocks. Well, with rising interest rates and record levels of inflation, government backed bonds are simply not viewed by these investors as being particularly attractive, especially if we talk about long term bonds that are far more sensitive to interest rate rises. Actually, new asset classes are coming on the market. Who hasn't heard of the cryptocurrency? Everybody knows someone that has had some success in that area. And it has created a real desire on the part of investors to participate in some of these fantastic wins that they hear everyone bragging about. However, for every Bitcoin success story, the road is just littered with failed investors that bought into some exotic coin and then they suffered a 100% loss. You know, the key to being successful in investing is managing risk, where you're not over allocated on what you are sure will work. So, in other words, my advice would be when you're sure that your investment's going to work, when you get that feeling like there's no way it can go wrong, I know what's going to happen with the market. I know what's going to happen in the future. I've got the best investment. That is the one that you should be the most careful with. That is the one that you should be reducing your exposure to, because the greatest losses are actually suffered when an investor takes a position with total confidence and then keeps buying all of the way down. So, traditionally, an investor might hold 50% in stocks and 50% in bonds with some adjustment for age. As they get closer to retirement, of course, the bond percentage increases. Assets like gold, silver, cryptocurrency, they should ideally make up perhaps 10% of a well-designed portfolio, with about 40% in bonds, mortgages, and rental properties. The rental properties are ideally passively managed. You should invest through some sort of a structure where you are a limited partner, where you don't have to be a general partner and actually manage the asset, unless you want to do that work. Some people like doing that extra work. But if you prefer passive income where you don't have to hassle with it and you just want to focus on your core business and you're not an expert in real estate, then usually it's better to be a limited partner. I would also stay away from single family rentals. Nothing wrong with buying them. I still sometimes buy them, but frankly, they are a lackluster investment when you factor in your own time involvement in the project. So an investor would do better to really find an experienced apartment investor that's already in the market, already buying a multifamily, compared to going and buying some single family homes. And with regards to bonds, an investor should look at emerging market bonds and corporate income bonds that pay higher yields. This can help to offset some of the negative effects of inflation. Just remember that it's very difficult to time the market, and take that into your planning. With regards to bonds, I know two companies that could be an excellent choice for an investor. Some investors, though, they are going to move entirely out of bonds because they're so worried about inflation, and they're going to put everything into cryptocurrency and stocks, thinking that that's going to be better. But they neglect the possibility that cryptocurrency and stocks could do the opposite, where they actually result in even greater losses. Now, it's hard to know what's going to happen, but it's important to hedge your bets. The best is still to hold bonds, but I would suggest shortening up the term. Maybe just a 5-year term bond, maybe a 1-year term bond, something like that could be ideal. And then I'd go with the other half in equities, but not entirely blue chip companies. Some smaller companies may have a far greater rate of return at exit, so you don't want to neglect that. I would say the greatest success is realized by those that work with other investors that have more experience. So if you'd like to learn more, please contact my office. I will help you, or someone from my office will. I have connections with family offices in the United States and in Europe, and a good network, and can point you in the right direction either way. Thank you.